Nordson Corporation decisively beat consensus. I mean, Q3 revenue hit a record $817.7 million. That is a 10.3% year-over-year increase, easily topping the $779.5 million estimate.
Yeah, and adjusted EPS came in at $3.25 against a $3.09 expectation. Management even raised their full-year fiscal 2026 guidance across the board.
Right. They're now projecting revenue up to $3.075 billion and adjusted EPS up to $12. The market absolutely loved it. The stock jumped over 5% following the report.
And KeyBank immediately raised its price target to $360. It's a huge reaction.
So today we're taking a deep dive into these filings to figure out if this massive earnings beat is, a sign of long-term dominance or just a temporary spike driven by the electronics cycle.
Yeah.
Because if you think of Nordson's core business, precision dispensing, they build these machines that perfectly calibrate fluids to the micromillimeter without wasting a drop.
Exactly, yeah.
And right now, their financial execution looks exactly like their equipment, just perfectly calibrated.
Well, and the segment perfectly calibrating that top-line beat is Advanced Technology Solutions, or ATS. Revenue there just surged.
By how much?
28.4% to $219.9 million. That is heavily driven by electronics demand, and they somehow managed to pull in a 30% EBITDA margin on all that growth.
Wait, I have to stop you there, because the other segments are actually what caught my eye.
Oh, really?
Yeah, the Medical and Fluid Solutions division maintained a massive 38% EBITDA margin, and Industrial Precision Solutions held at 35%. Total EBITDA hit a record $262.5 million.
It's incredibly high.
But I have to be a little skeptical here. I mean, is a 38% margin in the medical segment actually sustainable?
Well, that's a fair skepticism.
It just feels like advanced tech is doing all the heavy lifting for revenue growth,
Yeah.
while medical is just running unsustainably hot to prop up those overall margins.
I get that, but those medical and industrial margins really aren't a fluke. They reflect the highly specialized nature of the technology. Like, when a customer relies on your equipment to manufacture life-saving medical devices, the switching costs are incredibly high. They are going to swap out a critical component just to save a few pennies,
Yeah, that makes sense.
That lock-in really protects the margin over the long haul.
Okay, so high switching costs protect the revenue you already have.
Yeah.
But to see if Nordson is actually growing, we have to look at their future pipeline.
Definitely. And management kept praising their Ascend strategy.
Which is essentially their blueprint for driving top-tier growth through organic innovation and targeted acquisition.
Exactly. But the number that really jumps out is their backlog. It's up a massive 35% year over year.
Wait, really? 35%? But does a jump like that indicate genuine, durable demand from these sectors? Or, are these customers simply panic ordering because they're terrified of supply chain bottlenecks?
That's the billion-dollar question, isn't it? But if we look at the cash flow, it tells a story of genuine operational strength, not just, phantom paper demand. Well, they generated $530.2 million in free cash flow year to date. That's real money hitting the bank, which allowed them to repay $258 million in net debt.
Wow, okay.
Yeah, they've optimized their net leverage ratio down to a highly flexible 1.7x. They are actively converting these orders into cash and building a really defensive balance sheet.
But let's look at the mechanics of that cash flow for a second.
Yeah.
There are some cracks if you dig into the filings.
Oh, for sure.
Their free cash flow conversion actually dropped this quarter, down to 144% from 180% a year ago.
Right, and to explain why that matters to you listening, think of free cash flow conversion like a high-end restaurant.
Okay.
You might be selling a ton of expensive steaks, that's your revenue, but if your ingredients are suddenly sitting in inventory or customers are paying on a delay, the actual cash going into the register at the end of the night drops.
Right, the cash isn't liquid.
Exactly. Nordson is still highly profitable, but the efficiency of turning those profits into liquid cash slowed down this quarter.
Yeah, and that pairs directly with their heavy reliance on the electronics sector for profit. It's like having a star athlete who completely carries the team.
Right.
If the electronics sector sprains an ankle, does this entire earnings report hobble? Because despite this strong quarter, there was significant institutional profit-taking. Millennium Management and Mass Financial both reduced their stakes by roughly 50%.
Yeah, that institutional selling suggests some smart money is, locking in gains before the hardware cycle potentially turns.
Because the market is pricing in sustained electronics growth right now.
Right, but we know those cycles are notoriously volatile. If electronics peaks, the pressure on the medical and industrial segments to compensate will be immense.
Which leaves you with a fascinating strategic question to ponder. Nordson's capital allocation future is completely wide open.
Absolutely.
With that optimal 1.7x leverage ratio providing significant dry powder and their current heavy reliance on electronics for top-line growth, will their next major M&A move be aggressively targeted at diversifying away from the electronics cycle?
They definitely have the cash to buy growth in other sectors.
Exactly. Now we wait to see if they pull the trigger. But make sure to follow the show for your daily, no-nonsense earnings coverage.